Real estate can be much more than just where you live. It can be an income plan for retirement. It can be flexibility of lifestyle. It can be some source of emergency funds if needed. There's a lot of different strategies. Today, we're going to take a look at several of the more common ones and see how that might fit into your retirement portfolio plan. Let me grab Walt and we'll dive right in.
Got a great episode for you today. I'm Walter Storholt alongside certified financial planner Steve Smith of Powerhouse Financial Advisors. And this is going to be a good episode because we're doing a little sidestep from market talk and sort of the regular old financial planning stuff. We're going to talk a little bit more specifically about real estate, but real estate in several different forms and ways and how it might bleed its way into your life. And not all 7 of the things that we cover today will be something that you come across, but I bet a few of them will be things that you've either encountered in your life or will as you get older and get closer and into retirement as well. So this should be pretty fun. Steve, you ready to tackle these kind of real estate topics today?
Yes, let's get right into it.
Okay. We hope to answer the question of, can real estate boost your retirement plan or play some role in it? So we've got 7 different angles to tackle this question from. Let's start first, Steve, with rental properties. Do you ever have clients who want to use rental properties? Do they have them, and do they want to use them as some part of their retirement? How does that usually play out?
Yes, it's not a big majority. It's definitely a smaller group, but yes, some do them. And I would say a majority own their own home. Now, there's some reasons why some people don't. So most people are familiar with owning a home and what kind of comes with that, replacing the air conditioning and, leaky this, that, or the other, and remodeling and carpets, rugs, all this kind of stuff. So a lot of people have a good knowledge of that, what it all takes. But they're usually not tracking all of the expenses, like what that is. And if a client has been doing that for, say, the last 10 years before retirement or 15 or 20, I get real excited about it and talk about how we can maybe optimize that depending on how they've done and how they've managed it. Maybe we just tune it up a little bit. Depends on the situation. But rental properties can really provide a nice little boost, especially if you've got a lot of that paid for already. You're in a really good equity standpoint. You're not dying in interest and principal payments. So they can be a really wonderful thing in a portfolio. But I always, and I'll give you a nice little teaser, because I don't know what your particular portfolio looks like for a listener out there, but I always tell them, even if they've been managing it for the last 10 or 15 years or more, just remember that you're pulling a job into retirement. And a lot of them look at me like, what do you mean? Because now you're going to continue. You may be retiring from your 9 to 5, but you are still fully in control managing this business. Even if you outsourced to some management and decided to let some of that income go to a management facility, but at the end of the day, you're responsible for that business making money and not pulling down your portfolio. So there's a lot of risk to pull rental properties into retirement, depending on how well capitalized you are. And a third thing, this is probably the longest one of all of them. Third thing is what is your plan when you get well into your 70s, maybe 80s, when you're not really capable and able? Who's going to take that over? And are you going to sell into a good market or bad market? Nobody knows the answer to that, but it's something to think about. 65 to 80 is not that long of a time frame.
Have you seen folks make that decision to liquidate their properties so that they, 1, get rid of the job, and 2, can have a little bit more surety of when they're selling off those homes, maybe more comfortable with where the market might be today, as an example, versus the unknown of years in the future, and then manage that money in different ways than inside of this real estate bubble or real estate wrapper, rather?
Definitely, especially if they're coming in with maybe 3 properties, for an example. A lot of times they'll retire a little bit earlier, or they'll retire more secure by liquidating one of those. And a popular strategy, you have to take a look at it, but a popular strategy will be to liquidate maybe one that's hard to rent, or maybe that has the higher mortgage on it. So the other one's a little easier to cash flow.
Okay, very good. Up next, we have home equity lines of credit, or just leveraging home equity if you want to expand it out a little bit. A HELOC for short. Some may have heard some of those options described as before. Hey, I'm in my 30s. I've used a HELOC before, so I can raise my hand on having had a little bit of experience in this realm. So I don't know if that'll be my last one, but do these pop up for folks in retirement? Where can people leverage these, or why should they be aware of them?
Well, I think every HELOC should come with a big bright red warning label. Not a do not touch label, just a warning label, because they can get people into a lot of lifestyle trouble. Not so much in the 30s, they could, but if they've got $1 million of equity and they're getting a HELOC for $500,000 or something, whatever it is, they can actually, that lifestyle creep can come into the HELOC and actually turn it into a pretty rough situation. And you might inherit a mortgage in your 70s because the HELOC was managing the excess of your lifestyle. Kind of like in your younger years, in your 20s, you might use a Visa card for that. But these HELOCs can kind of become the Visa of the 60s and 70s. So you got to be very careful with the HELOC for retirement. I really love them because they provide a lot of opportunity for maybe a remodel, maybe starting a business. You can pull a little bit there with a reasonable interest rate. There's all kinds of things that they can be good for. But in retirement, I don't mind if people have them, but it's kind of like the pull of last resort, if you will, from a loan perspective.
Would you ever see a HELOC working as an emergency fund for somebody?
If they're going through a string of really bad luck that they blew through, say maybe an appropriate emergency fund for this example, let's say it's 50,000, and they had a couple funerals to pay for, and then they had a little bit of down luck. They had to replace their HVAC system and a few things. Sure, it can be a short term little catch beyond your standard emergency fund, so you don't have to sell your portfolio into something. But I would say that's more rare than common.
Yeah.
That people
True last resort is how you see it in retirement for folks.
Yeah.
The emergency to the emergency fund, if even that.
And somebody in their 30s, or even somebody like yourself, Walt, when you're still in the accumulation phase, they provide some opportunity, because they can get you into better interest rates, and you can actually provide value back into your home by using that home equity line, because you don't want to give up your, say, 2 or 2.5 or 3% mortgage. They're wonderful things. So I don't want to downplay them too much, but in the retirement plan, focus, I'm not that big of a fan. I like people to have them, but I really don't like people to use them.
That's a great way to describe it. Not bad to have it, but let's try not to use it. I like that. Makes sense. What about REITs? REITs, real estate investment trusts, I believe those are described as. I feel like some people will have come across this term before, and maybe you're running into more and more people owning these in their portfolios.
Definitely. And we work with several of those when we're doing our financial planning. It's an alternative to having, say, like number one was rental properties. With a real estate investment trust, somebody's managing a group of properties, and you're putting money in so that they can buy more or capitalize what they have. So that kind of thing. So you're basically it's almost like a mutual fund for rental properties, if you will. And they might have some kind of objective of only commercial or only malls or only, whatever it is that they're into. So you can get specialized with these, but I like that because you're diversified. One of the biggest problems, I didn't mention it before, but with rental properties is what everybody says about real estate. It's location, location, location. And depending on, and sometimes that changes, whether it's a good location or not, or maybe the factory closes, or maybe a company puts a factory 10 miles down the road and nobody can find a place to live. Those kind of things can all affect that are really outside of your control. And when you have a portfolio of 500 properties that you own a portion of versus 3 properties It's kind of like your portfolio of three stocks, right? That can go really well for you. It can go really badly. And it's the same type of thing. Real estate can diversify, of course. You can actually do sweat equity in your rental property. So there's different ways that they can be good. So I don't want to push them out, but in retirement, I like people to enjoy more. And if they're interested in those real estate investment trusts, I do encourage those.
Great way to have maybe real estate as part of your portfolio without all the hassle of running your own rental properties. What about reverse mortgages? They obviously, I think, marketing around reverse mortgages gets targeted to a lot of seniors and people of retirement age and in that zone. What's your thoughts on those?
My thoughts on those are not good. And I just talking about the industry. I'm not talking about any particular company that does them. They're providing a service that is necessary to a certain segment of the population. Usually, when I called the home equity lines, is kind of like the loan of last resort. But that's when you're maintaining your actual retirement plan. I would say reverse mortgages come in when your retirement plan has failed and it's breaking down.
Okay.
That's when they can be used. I don't even want to say a good idea, used. So you've kind of blown through your portfolio, right? You've blown through a lot of your cash, maybe other than a small emergency fund, and your house needs a few little repairs, but you want to stay in your home longer. And you want to keep your independence and everything longer. If you got a reverse mortgage, it will provide for those repairs for the house, and it'll take that mortgage if you have one down, or will provide a supplement pocket of emergency funds that you can pull from. So really, it's kind of when the retirement plan has failed, that's when the reverse mortgage kind of pops up on the scene.
Okay. So not something you're really incorporating into a plan because the plan should never lead to that reverse mortgage step.
Correct.
Okay. Very good. What about house flipping? This seems to fall into that rental property category of, I don't know, a young man's game.
Correct. So when you're in retirement, it kind of depends on what your history is through your career. So if you're kind of a real handy, or maybe you had a certain career that was behind a desk, but you found yourself with a tool belt on most nights, and you had the most in repair house and yard ever, because you were just, that's kind of like half of your hobby. It was just, you just love that. It's like, yeah, we put new cabinets in, and like, didn't you have new cabinets like 5 years ago? Yeah, but I built them myself. It's great. If you're that guy or gal, then this flipping thing might be a cool little, I'm going to retire at 60 and I'm going to actually buy these houses and spend 6 months or whatever it takes to flip a house to add, and really you just kind of enjoy that. I have one client that did that for 3 or 4 houses and was very successful and actually happier doing that in his 60s than he was when he was working. So for the right person, flipping can be good. But you also need to be in a rising market as well, because you got to be careful. It's not for all markets. You want to be in a good housing market that you're not going to lose while you're retooling this house.
That can carry a lot of risk with it.
Correct.
Okay. All right. What about 1031 exchanges?
It's one of my favorite things, because that's how you avoid taxes. And pushing taxes down the road is a very, very, very good thing, whether it's a pre-tax 401k or it's a cash balance pension or even a Roth. Even though those taxes are paid, you're growing tax-free. Those things are wonderful. 1031 exchanges are just in the real estate side of life. It's very much like what a pre-tax 401k does. You can just sell the stock and buy another one, and you don't have to pay taxes on it because it's in that tax shelter. Well, you can own a rental property and buy another one, sell that one, and roll it over and defer the taxes as well. So 1031 exchanges are just a great way to keep Uncle Sam off your back for a few more years.
Okay, very cool. This does not apply to primary residence sales and moving, right? This is only for rental properties?
Yeah, well, there's a different rule for primary, just to throw this one in as a little bit different thing. So if you're married, up to 500,000 in gains. So let's say you bought a house for 250,000 long ago and you sold it for 750 today. Well, you'd get free capital gains of your cost basis, of course. There's nothing there. That's a cost basis. And then that 500 in between, they wouldn't pay any taxes on that house if they sold it for 750. If they sold it for 800, they'd have $50,000 in capital gains. If they sold it for 700, still no taxes. So, and if you're single, you get half of that, 250,000. So you're protected in a different way there.
Okay, makes sense. Last but not least, as we talk about real estate in your retirement plan, would be downsizing. I'm sure that's a conversation that you've had with a lot of clients when they get to that precipice of retirement, or maybe into retirement a little bit later on, or maybe relocating to just a different state or even a different country in order to free up more funds for use in the retirement plan. How often is this coming up with couples and individuals that you talk to?
Well, I live in Nevada, low tax land, which is wonderful. But a lot of my California friends are coming over here every day. And I just tell them when they're coming over, a lot of them will get a bigger house, not even downsizing, upsizing, but they're downsizing in cost. So they're actually pulling money out by getting a bigger house, which I think is a win-win if you want that bigger house, of course. But the main thing there is if downsizing is in there, whether it's a bigger or smaller house, you're downsizing your cost and pulling money out. I think it's a great way to increase your lifestyle, increase the security of your retirement. And some people want, they're retired. They want to take care of a nice yard on a couple acres. Others want something small because they want to, just take their golf cart down to hole one at 7:00 in the morning and, just open the garage and drive down and everything's done for them. Everybody's different, but I'm all for downsizing. I'm all for going to a more tax advantageous location so you can have a bigger house, whether that's just the price of homes or the taxation itself is the windfall.
Yeah. That's a great to hear that you can have that conversation with folks. And when they have that opportunity, it can probably move the needle a decent amount for somebody to free up those extra funds or just get exactly what they want in retirement. So cool to hear all of these different ways that real estate can be leveraged, or some of these were ones where it was kind of a red flag moment. Like, let's be careful with these items in retirement too. So not all is, glowing and glittering in retirement when it comes to talking about real estate. So I appreciate both sides of the coin on this conversation, Steve. If you'd like to dive in a little bit more in depth into your financial plan, not just with how real estate plays into the equation, but other items as well, don't forget to reach out to Steve. He can have a conversation with you about your portfolio and about your plan. In fact, it's good for you to know, if you're new to the show, that Steve has contracts with every publicly traded utility company in the country, where employees can manage self-directed brokerage accounts to give them more options and flexibility than you would find in traditional 401ks. And this is really unique to the industry and something that Steve can help you navigate and work through. If you want to find out more about that and the other ways that Steve helps the industry, certainly reach out. We've got a link in the description of today's show to book an appointment and a review of your portfolio, as well as links to other resources and helpful information as well. Steve, thanks so much, and we'll look forward to talking to you soon.
Thanks, Walt. Appreciate everyone listening.
Yep. We'll see everybody next time right back here on Power Your Retirement. This podcast is provided by Powerhouse Financial Advisors, an independent firm with advisory services offered through Parson X Advisory Services, Inc., PAS, a federally registered investment advisor. The information provided is for informational and educational purposes only and should not be considered as personalized investment advice. PAS does not guarantee the accuracy, completeness, or suitability of this information for your specific circumstances. Investment decisions should be based on an individual's goals, time horizon, and risk tolerance. Past performance is not indicative of future results, and all investments carry a degree of risk, including the potential loss of principal. Any case studies, testimonials, or endorsements shared in this podcast are illustrative of individual experiences and may not be representative of the experience of all clients. They do not guarantee future performance or success. You should not infer any level of assurance regarding future financial outcomes. Listeners should consult with a qualified financial, tax, or legal professional before making any investment decisions. Parson X Advisory Services, Inc. does not provide tax or legal advice. Be sure to consult with your tax and legal professionals regarding your specific circumstances. For a copy of our Form ADV Part 2A, which provides additional information about PAS, including our advisory fees and services, please visit powerhousefinancialadvisors.com.